Hi guys, it's Zhang again from Moolahwise.com. And today I want to answer a comparison or a question that we usually get about comparing owning a real estate to comparing to owning a 500,000 IUL. I get this question a lot since I am from California and owning real estate is very popular out here. So we get this question all the time where we compare real estate versus owning an IUL. And again, please do not take this as legal or financial advice. This is supposed to be served as entertainment as well as educational. So please reach out with your specific situation so we can assess your numbers. But this is just for informational purposes only. So let's get into it. So comparing real estate versus owning an IUL. So like I mentioned, they're not really the same vehicles or same investment vehicles, but we get this question all the time. So I just wanted to share what we share. So before we get into that and compare apples to oranges, we have to talk about the three buckets of taxes. In the USA, there's really only three buckets of taxes that we are taxed. So the first way is called tax now, and everything in this bucket gets taxed every single year if there is any gains on it. So the typical accounts in this bucket are savings accounts, mutual funds, stocks, CDs, bank CDs, I should say, and real estate. And is depicted by this graph, where every year, if you make anything or if any of these accounts grow, you will have to pay a piece to Uncle Sam. And if these accounts grow bigger, then the amount that you pay to Uncle Sam also gets bigger. So it's depicted by this graph. So each one of these lines represents years. As the program gets bigger, you would have to pay more and more and more. The next bucket is what we call the tax later. And think of this bucket as your retirement accounts. And the accounts in these buckets are individual retirement accounts or IRAs, SEP or simple IRAs, your 401k, 403b, slash 457, your pension, your annuity. Think of this as every year you get a temporary tax deduction. So you don't pay any taxes in the early years, but the year you take it out is the year you will pay the taxes or whatever that current rate is. And so I like to ask my clients is, do you know what your current tax rate is going to be the year you retire? And most people say no. And if, for me, if I don't know what the tax rate is going to be, then doesn't it make sense for you to pay the taxes when they're on sale or when you know what the rate's going to be? And which leads me to the last bucket, which is called the tax advantage, or also known as tax-free. So the money in these buckets grows tax-free because it's funded with after-tax money. So some of the examples of the tax advantage buckets, tax advantage are like a Roth IRA, a Roth 401k, or Roth 403b, or Roth 457, or 529 college savings plan, or cash value life insurance. Or in our case, we're just comparing index universal life, or IUL, compared to real estate. So I like to ask yourself, where are you currently saving your money? Is it in the tax now bucket, where every year, whatever growth you get, Uncle Sam gets a piece, and the bigger the piece that goes to Uncle Sam? Or are you saving it in the tax later bucket, which means you don't pay any taxes now? Since it's funded with pre-tax money, you won't pay any taxes now, but when you do take it out, then you will pay the taxes on it. Or are you saving your money in the tax advantage, where you don't pay any taxes later on, but you pay taxes now? So think of this as paying taxes on the seed when you put your money in the tax advantages bucket, and think of this as paying taxes on the harvest. So I want you to ask yourself, where are you currently saving your money? So in our discussion today, we're just going to compare IUL to real estate. So let's get into it. So let's make some assumptions first. So let's assume our client is going to be male. He's age 35. He's healthy. He makes about $100,000 per year gross before taxes, and he lives in California. And so how do we figure out what our mortgage payment is going to be? So you Google Investopedia mortgage amortization and enter the amount. So you enter 500,000, you enter 20% for the down payment. You select your loan term, and you select your interest rate based on your credit score. And then it will also spit out the property taxes. And so you come up with this amount, $2,710 per month. And how they came up with that is they took $1,897 plus $666.7 for property tax plus $146. So I summed it up with this chart. So basically, to the owning a cost of real estate is you had to get an initial down payment of 20% of 500,000, which is 100,000. You'll be borrowing $400,000 at 3.947% fixed for 30 years. You will assume 1.6% in property taxes, or about $8,000 per year. Homeowners Association, I assume 0 since it's a single family home and we might not have any homeowners association. Monthly maintenance, you assume 0, just for easy calculation. Homeowners insurance, we assumed about 146. Again, these numbers are coming from the website that I shared with you previously. Your numbers might be different depending on your credit score, depending on where you're buying the house, and depending on how much down payment you have. But in our example, it's going to be about $2,710 per month. So this is the cost of owning a real estate, owning a $500,000 home. So the next is we want to compare it to cost of owning a $500,000 IUL. Since we are appointed with Transamerica, we ran it with Transamerica numbers. And so these are the costs to own a $500,000 IUL with Transamerica at age 35 and healthy. So you add up all the costs, which is about $2,062 per year, or $171.83 per month. Since our IUL example is only $171, we decided to increase this amount of $171 to closer to the mortgage amount. And like I said, in IUL, the premiums are flexible, so you could max fund up or you could pay the minimum. So what we ran was a target premium, which was slightly above the minimum. So basically, we max funded up, and then we reran the illustration showing the cost at $500,000 when you max fund. So this is the cost showing the IUL when you max fund it up. As you can see, the cost gets a little bigger because you're putting more money away and you're saving more money, so they charge a little bit more. So these are our costs, or $30,000 per year. When you divide that by 12, you get about $2,545. Just we bumped it up so that way we can compare it to our mortgage amounts for a fair comparison, a more fair comparison. So again, just to reiterate, these are all the numbers that we got from our previous slide, and we're just going to put it up side by side to compare owning a 500,000 IUL when you max fund it up. So again, it's 2,710 versus 2,545. And the question I always get is, yeah, but my real estate, my house appreciates. And what we always say is like, the IUL also appreciates if you know how to structure it right. So I'd like to ask yourself, how much will your house appreciate in 30 years? And we don't know, because depending on inflation, depending on what the market is doing, depending on the location too, we have no idea what your house could be appreciate in 30 years. But we can figure out how much you will pay in mortgage payments over 30 years, which is you take what you're going to pay per month times 12 months in a year, and then times 30 years will give you $975,600. And this is the total mortgage payments that you paid over 30 years. So I'd like to ask this, since we're comparing IUL versus owning a home, I'd like to ask that same question. How much will your IUL, your $500,000 IUL appreciate in 30 years? And how much would you have paid in premiums over 30 years? So let's make that comparison. So we ran the numbers again at max funded, and so these are all the numbers at max funded. Your cumulative premium is $687,000. Your cash value or policy value is at almost 2.1 million. Your death benefit is 3.1 million. It is an insurance, so there is a death benefit. So I'm just putting the costs up. So on one side, this is how much you would have paid in mortgage which is 975,600. Or would you rather own a 500,000 IUL where you pay the cumulative premium paid into the program is 687,000, but your cash value is almost 2.1 million, and your death benefit is $3 million. So I'd like to ask yourself, I know your house will appreciate, but do you think it will appreciate more than $3 million 30 years from today? So that's it. That's our presentation. So I hope you enjoyed this comparison. If you have any questions about IUL, please reach out to us at info@moolahwise.com, or you could take our free money quiz at moolahwise.com/quiz. Or if you want, you could just schedule a sit down with us at this website, calendly.com/moolahwise. Again, it's Zhang with moolahwise.com. And again, please do not take this as financial or legal advice, because everyone's financial and legal situation is different. Please consult with your financial and legal professional before you decide on owning an IUL or owning any real estate or owning anything. So thank you for listening. And again, reach out to us if you have any questions. Bye.